Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently one of the brothers in the community asked me to look at this company, and this is one of the companies that we've never actually discussed in this channel, and at the same time it seems very interesting from a dividend growth perspective, so we're going to look at that company today. But before we do that, just always make sure you do your own research. I'm just going to give you a quick overview of what the company does. I'm going to give you some of the financials, look at some of the important things that we normally look for, some of the financial side of things. We're going to look at the dividend growth side of it, if they can sustain that dividend. We want to see the free cash flow, the growth in terms of the revenue side of it, in terms of debt levels. So we can look at those things, but it's very important that you also look at in more depth, inshallah, if you're interested in this company. But before we get to the company, it would be wonderful if you can just press that like button. Like I always say to you guys, it takes a lot of time and effort to put these videos together. And of course, if you can, it will be wonderful to have you on the Discord, where you can actually join a Patreon account. You get access to all of these things, as well as the Discord, where a lot of brothers are sharing good practices. That's where I basically share all my buys and sells frequently. So inshallah, then of course you get some benefit out of that, inshallah. Adobe, I think, just reported $523 per share, so that means it's actually down quite a bit. So we'll see what basically the report says. Adobe is one of the companies I'm interested in, so let's see what basically they say. Yeah, let's get started with this company. And the company that we're talking about today is Watsco. This is new. I've never spoken about this company before, and as you can see, a year to date is actually up 33%, so that's interesting. Sorry, a year to date is down 7%, but for the 1 year is up 33%. As you can see here is a hold for Quant, Wall Street, as well as the Seeking Alpha Analyst. So the company, what do they do? So they work in the AC side of things. So basically, this is what they do. Okay, so their business model is, it says a broken or failing basically AC unit at home or business. Basically, they send the contractors. They come to your house, they check it, they understand what the basic needs to be done, then they go away and buy the equipment that they need, and then they come and fix it and replace it completely. So it's a very simple business model. So this is a company that deals with a lot of AC, and that's it really. There's not much to it. So let's have a look at the financials. Right now, as you can see, they have $14.7 billion. So it's a large cap, but it's not a huge company if you think about it. Dividend yield of 2.69%, and the safety right now is a borderline safe. Okay, 72%, that's probably why, 72% payout ratio. So that means they're spending quite a lot of their net income paying that dividend. So we'll see the free cash flow in a bit, and they have increased that dividend for 10 years. And as you can see here, like I said earlier, when it comes to dividend growth side of things, they are very interesting, because 10% latest increase, and then 12% in the last 5 years, which is quite nice, and 21% in the last 20 years, which is really huge. And as you can see, they cut that dividend around 2013, and then since then they've been increasing that dividend. So 10 years of doing that, you'll get $10.80 for every share of this company that you own, which is absolutely huge. But remember, the stock price right now is 400. For that reason, it's about 2.69. It's around that anyway. So moving on to the next section, as you can see, it seems a little bit overvalued at the moment, because the 5-year average is over 3%, and right now we're looking at about 2.7% of dividend yield. In terms of the average PE, we're looking at 25. Right now is about 28, so it seems a little bit expensive. The industrial sector right now is about 20. The company is trading about basically 28 multiples right now. Now, in terms of earnings per share ratio, right now, normally, remember, 60% and below 60% is what we're looking for. Right now, we're looking at about 76. So 72 right now, 76 in the next 12 months, which is absolutely huge. And looking at free cash flow payout ratio, right now it's about 68. Next year, about 67. And 60 is the cutoff. At some point, 2018 was 125. So it has come down quite a bit, but it's still not good enough. Earnings per share right now, we're looking at from $4 to right now $14 in the last 10 years, which is absolutely huge. Free cash flow per share is also heading the right direction. And when it comes to shares outstanding, they have diluted, I think 2013 they've actually diluted the shares, and next 12 months it looks like they're just going to keep the way it is. And then total sales from 3.9 almost $4 billion to right now $7.2 billion. And we will look at that in more detail, this part, in a second. Return on equity, we reckon 26%, and return on invested capital of 25%, which is really good. Operating margins about 11%, 12% for this type of company, but it's okay. Free cash flow margins of 7%, which is not bad at all. And right now, net debt to EBITDA, right now, it doesn't basically non-existent right now, which is quite nice. And looking at, so going back to Seeking Alpha, if we go to earnings, for example, and then go to the estimates, we want to see what the analysts are saying this company moving forward. And the reason we look at this is because it really helps us to actually, of course, if you invest in a company, you need to know where the company is heading in terms of basically EPS and in terms of revenue side of things, right? So if we just focus on the first three only here, you can see 5.6, 11.8, and 10%. For the next 3 years, which is not bad at all. So it's basically heading in the right direction. As well as that, you've got $7.7 billion of basically of revenue up to almost 8.8 in the next 3 years. So about 6% every single year, which is not bad at all. Completely, absolutely not bad at all. And looking at the growth side of it, so current year they're expecting about 37%, basically 37%, and then in terms of next year 51%. And then the year after 25%. Am I looking at the company? This is crazy. Hold on a second. Yep, I knew I was looking at the wrong company. So about 5% this year, 12% next year, and then 4%, 4.5% following 5 years. So I knew I was looking at the wrong company. And as you can see, it's $410 when it comes to the average price. Right now it's $397 per share. Looking at Morningstar, in the last 10 years, the company has actually had total return of almost 17%, which is really good. And currently, as you can see, is 1 star, which means it is quite expensive right now. So 47% premium right now, as you can see there. Their current price is over $400. They expected the price to be $277 per share. It has a narrow economic moat. So now what I want to see is the revenue side of things. So as you can see here, the total revenue for the last 5 years, so 4 years in fact, it's 2020 was about $5 billion to right now $7 billion, which is not bad at all. So 6.2, 7.2, right now that's where we are, about 7.2. So it's gone up a little bit in 2020 from 2022 to 2023. So it's not really grown massively. The cost of the revenue though is about 3.8. So a lot of that, so they're only making about $2 billion for basically in terms of gross profit, which then means they're going to have to pay all of these taxes, and then the net income is not really great. So basically we're looking about just $500,000, basically $500 million of basically off that $7 billion. Now if we look at the free cash flow here, okay, as you can see, it's a positive, so which is not bad, but it hasn't actually grown a lot. So in 2020 it was 500, and right now it's again it's the same thing, 526. So not much growth in terms of the last couple of years, last 4 years. So although it has a positive, which is quite nice, and in terms of we already know in terms of debt levels is actually not bad at all. So what I'm going to do now is show you basically some of the competitors and basically how they performed against the S&P 500. As you see, I can see this is the company. So for 1 year it's up 38% total return, that is 31% for the S&P 500, and there are found a couple of other companies that do similar sort of businesses. And basically it's for the 3 years, as you can see, is about, let's call it 70%. The S&P 500 is only doing 30%, and then the other companies are more or less similar. And then when you look at the 5 years, 237 and to 83%. So it's actually beating the S&P 500 into basically every single, well, for the 1 year, for the 3 years, for the 5 years, for the 10 years, 446. Right now the S&P 500 is 176. So it's actually beaten the market massively over the last 5 years, 10 years. So it seems really interesting company, but when it comes to valuations, that's where the problem is, because the 5-year average of 28 and right now it's about 29, so it's way higher. And according to basically this, right, so we've done valuation from Morningstar, Seeking Alpha, Simply Wall Street, and the multiple valuation model that I used gave us $342 per share. current price is 397. That's about 14% upside, basically downside from where we are now. So if you have some sort of a margin of safety, let's say 5%, so you're looking at about $325 per share. Anything higher than that I wouldn't pay, to be honest with you, because it is a small cap company. Anything can happen. You might want to say, okay, I want to only buy this company with 10% margin of safety. That would be about $308 per share. That's basically 300, so almost $80 from down from where it is right now, which is not bad at all. I mean, these companies can fluctuate, and if you look at over the last whatever years, I'm sure at some point, not long ago, it has been trading around that price. So if we look at, for example, last 10 years, this company was actually trading 100 something to right now almost to 400 something. So let's see, 2021 it was 227. In, let's say, 2019 it was 160. Oh, that's when the okay, so that is when the COVID happened, March of 30, 2020. It was down almost 147. So yeah, you might see a drop. If you see a huge drop, of course, then it will be a good opportunity to, if that's a company that you're interested in, of course, then you do what you need to do, inshallah. But yeah, that's the basically I wanted to share with you guys. And of course, as always, do your research. And I'm absolutely exhausted. I just came back from work as well. Been fasting all day, so apologies if I'm a little bit off, but have a wonderful day. And as always, please, if you like this type of content and you want me to continue, inshallah, doing this, let me know. By the way, if you have any suggestions and companies that you want to look at, inshallah, and whenever I get a chance or basically a gap in between the videos I'm planning, whatever, then I can do a quick one, inshallah, for us. Have a wonderful day. Assalamu Alaikum.